Well, good morning, everyone, and welcome to a little discussion here about financing your startup in 2021. So, you've probably seen a lot in the news about how the money is flowing freely right now. There's a lot of startup funding activity, a lot of startup funding deals that sound kind of crazy. And so I thought this would be a good time to have just a little discussion about financing your startup in 2021. And here's the kind of the agenda for this is that I thought we would. Sorry. I just want to say that the most important thing to know about financing a business in 2021 is that there's lots and lots of different sources of capital, sources and structures of capital. So although a lot of people kind of think it's all about Sandhill Road venture capital, part of what I'd like to do this morning is to kind of open up the solution set a little bit for you, that there's lots and lots of great ways to finance a business. It's not just about the venture capital on Sandhill Road. So this morning's agenda, I thought we would spend just a few minutes on kind of startup financing 101. In other words, terms, nomenclature. There's a lot of words that get tossed around, and I think it's super, super important to be really clear on what all these words mean and some of the standard structures for financing so that we can explore different ones and know which one is best for us. And then I'm going to offer a few tips and suggestions for you. And then I'd love to hear your questions. And on the topic of questions, please type them into the chat box there as we go along. Just whatever questions you have, type them into the chat box, and we'll try to get to as many of them as we can. So with regard to startup financing 101, kind of terms and definitions, let's start with the fact that all capital that comes into an organization is either debt or equity. It's really fundamentally important to understand this. And debt is, something we all understand, right? Debt is somebody gives me a loan and I got to pay it back over time, principal plus interest. That's it. There is no obligation beyond paying back the money, principal plus interest. The debt holder has no ownership of my company, and the debt holder has no claim to future profits of the company. So if the bank gives you a loan for $10,000 and your obligation is to pay that $10,000 back over 3 years, principal plus 8% interest, that's the obligation of the bank. The bank owns no percentage of your company. The bank has no claim to future profits. So I think all of us kind of intuitively understand how debt works. Equity is kind of the opposite in the sense that with equity, there is no repayment obligation. If a venture capitalist invests, $20 million into your company, you don't have to pay him back. So that sounds pretty good. But instead, they now own a percentage of the company, and they have a future claim to a pro rata share of all the profits in the company. So if a venture capital firm invests money, they now own, let's say, 20% of the company. If the company's ever sold, they get 20% of what the company sells for. And they also have a claim to 20% of all the future profits in the company. But there is no repayment obligation. So fundamentally, it's really important to understand debt versus equity. And that there are pros and cons to each, that some people kind of think of debt as being evil, and somehow or another, equity money is like free money. But that's not at all true. There are pros and cons to both. And in fact, in terms of a true weighted cost of capital, debt is really cheaper. In 95% of cases, debt is actually cheaper capital than equity capital. The reason that the equity capital industry exists is that it's pretty hard for a startup to walk into a bank and get a loan from a bank without doing personal guarantees. And so the real reason that the equity capital business exists is that debt capital is very difficult for startups to get. But again, I want to make sure you understand that all capital coming into an organization is either debt or equity, and that there are pros and cons to each. And then, you hear the term in Silicon Valley, you hear the term angel investor and VC investor tossed about, and the definition really is very simple, which is that an angel investor is investing his or her own money, whereas a VC investor is investing money out of a fund that they have raised, and other people have put money into that fund. And so that yields two really important outcomes. The first is that check size for an angel investor tends to be, 5 or 6 figures. So 50 grand, 300 grand, somewhere in that kind of range, because that's kind of more the typical range that an individual might be investing at. Whereas venture rounds tend to be, 7-figure check sizes, so $1 million or above. And then the other, perhaps more fundamental difference between an angel investor and a venture capital investor is that because an angel investor is investing his or her own money, they don't have a fiduciary responsibility to anybody else. They can just simply say, you know what, I met Jane, I like Jane, I'm going to invest money in Jane, because they don't have any limited partners who they report to. Whereas a venture capital investor, because he or she is investing out of a fund that's been raised, and pension plans and corporate investors and high net worth individuals who put money into that fund, the VC has a fiduciary responsibility to the people who put money into the fund to make good investment decisions. And so at the quarterly meeting, they can't say to investors, you know what, I invested in Nancy because I like Nancy. That's not an investment rationale. So what that means, of course, is that angel investors tend to be more early stage because that's where the gut level investing happens. And VC investors tend to be later stage because that's the stage where you can actually do some due diligence and make an informed investment decision. And then it's also important to kind of understand, with regard to venture capitalists, the mechanics of how that industry works. So a venture capital firm, Andreessen Horowitz or Sequoia, whoever it is, they decide they're ready to raise their next fund. And then they go out to high net worth individuals and pension plans and others and say, put money into our new Fund 6. It's going to be a $500 million fund. And here's the deal. We will actively manage the fund and make investments. And we will take 2% of the fund amount every year to pay for our rent and expenses and everything else. And at the end of the fund horizon, which typically is 10 years with venture funds, we will distribute all the profits back to the people who put money into the fund. And 80% of those profits will go to you. 80% of the profits go to the limited partners who put money into the fund. And the general partner, me, I'll keep 20%. So this is called the 2 and 20 system. And this is how basically every single venture fund works, is that they raise money from a variety of people. It's usually a 10-year horizon on the fund. And they take 2% of the fund amount as a management fee, and they take 20% of the profits of the fund for their compensation for managing the fund. So again, I'm telling you all this just because it's important to understand how their business works. And it's perfectly reasonable to say to a VC, which fund will you be making this investment out of, and what stage is that fund at? In other words, is it 5 years into its 10-year horizon? Is it 7 years into its 10-year horizon? And that's important to know because in the later years, they're simply looking to get liquidity out of the fund, right? In the early years, they're making the investment. The middle years, they're sitting on the boards. The later years, they're trying to sell the companies. So it's important to understand where you are in the life cycle of a fund. Now, every single equity financing fits this very simple equation, which is we have what the company was worth before. So let's say in this example that the company is worth $2 million right now, and the investors are going to put $1 million into it. And so now the company is worth what it was worth before, plus it's got the $1 million in the bank. And so the post-money valuation on this venture is $3 million, right? It was worth $2 million before, we put $1 million in. And so now the post-money valuation is $3 million. And now the math is very simple on who owns what percentage of the company, right? That, sorry, my slide transitions are a little messed up here, but I hope you're following along. That based on this math, then the founders own 2/3 of the company and the new investors own 1/3 of the company. And as I said, every single equity financing transaction fits this very simple equation. Very important to understand this. Now, the hard part in this equation, of course, is the pre-money valuation. What was it worth before the financing? And that's just simply a back and forth between the entrepreneur and the investor. The entrepreneur wants the number to be higher because that makes the percentage of ownership for the new money smaller. And the investor wants the pre-money valuation to be lower because that makes the percentage ownership of their new money higher. And sometimes this equation gets backed into. In other words, if you were to say to me, I'd be willing to put $1 million in, and I would expect to have a third of the company. And I said to you, okay, let me think about that. $1 million in, you have a third of the company. All right, that's fair. Let's do that. All we've done is just back into the idea that the pre-money valuation was $2 million. It's exactly the same math, right? So important to understand all of this. And when negotiating an equity investment, the key terms that you're usually negotiating with an investor is the percentage of the company that the investor is going to own, and that's based on the pre-money valuation. And then whatever special preferences the investors are going to have associated with their stock. So the venture investor typically gets preferred shares in the company, and the entrepreneur and employees get common shares. And the typical preference that the preferred shares have is liquidation preference, meaning that when the company is sold or wound down, that the first X amount of the liquidation proceeds go to the investors before anything gets distributed to the common shareholders. So a 1X liquidation preference would be 1 times the amount invested. So if I put $1 million into the company and the company ends up being liquidated, the first $1 million from the liquidation goes to me as the investor, and whatever is left over gets distributed amongst the common shareholders. So super important to understand this, right? And that the investors are always going to want to have preferred rights, preferred shares, liquidation preferences. And something like 1X is reasonable and typical, but sometimes you'll see early stage deals done where the investors say, I want 2X liquidation preferences, meaning I'm going to put $1 million in. And if the company is sold or wound down, the first $2 million out goes to me before you see a nickel. Okay, so you'll get a term sheet. Term sheet kind of looks like this. We won't dive into all of the terms right here, but we will talk briefly about a cap table as part of our Startup Funding 101. And a cap table is just simply, a capitalization table is just simply a list of everybody who owns part of the company and what percentage of the company that they own. So an investor will want to know, what does the current cap table look like, which means just simply what does the ownership share of the company currently look like. Now, I said that all capital that comes into a company is either debt or equity, and that is true. And then there's this hybrid instrument called a convertible note. And a convertible note is an instrument that says, let's call this debt at the beginning, and then it'll convert to equity in the future on some predetermined trigger. So this is a very, very common way for early stage investments to be made in startups in Silicon Valley. And the big benefit is that we're deferring the valuation question. So by saying it's debt now, then we don't have to agree on what the value of the company is right now. We don't have to worry about valuation, because this is just simply, it's just simply debt. It's just simply a promissory note saying you're going to pay back the money plus interest over some amount of time. Typically 2 years is what convertible notes are done at. And so we'll just call it that for now. And that way we don't have to worry about valuation. And if 2 years from now you raise a round of equity financing, whatever valuation you and those future investors agree upon for that future round of equity financing, we'll just simply convert these notes to equity at that valuation. So both parties are saying, we'll call it debt for now, and we'll punt on the whole question of valuation, and we'll agree that this will convert to equity in the future based on whatever valuation you get in the future from a venture capital investor, an equity investor. And typically there's a sweetener, meaning that this will convert at that future valuation, except I want a 15% discount on that future valuation because I took the risk of putting the money in early. So if the future investors are paying $1 a share, then I want to convert this note to equity at 85 cents a share. So that's called the discount rate in the convertible note. And then the other thing that you're seeing frequently these days in convertible notes is a valuation cap. And this is something that kind of has occurred in the last couple of years as valuations have kind of gotten crazy. And sometimes angel investors have been frustrated because they put $100,000 into a company thinking to themselves, so when this converts to equity, I'll probably have around 10% of the company. And then 2 years later, the company raises a venture round at $100 million, just a crazy valuation. And suddenly that money that the angel investor put in on a convertible note converts to equity, and they got 1% of the company. They're like, how is that fair? And so the valuation cap is putting into the convertible note the notion that we'll accept a future valuation of the company as long as it's under X. And if it's over X, then I still get to convert this note at X. So that's the valuation cap. Now, the last thing I'll say about convertible notes is that a few years ago, Y Combinator, the famous startup accelerator, they created their own instrument kind of in lieu of convertible notes called SAFEs. SAFE stands for a simple agreement for future equity. And it's kind of a simplified way of doing a convertible note. So convertible notes and SAFEs, conceptually the same thing. There are some minor mechanical differences, but it's essentially the same thing. It's a way of putting money into a startup early and deferring the whole valuation question until later. All right. Stages. So you hear in Silicon Valley, you hear a lot about seed stage and pre-seed and Series A and Series B. And everybody's like, what does that mean? So there are no hard and fast definitions of these things. They can be anything you want. Anything that the buyer and seller agrees upon, anything that the entrepreneur and investor agree upon. But here's kind of the typical progression in Silicon Valley today is that a pre-seed is, you have an idea and you just need a little bit of money to push the idea forward. And maybe that's 50 grand or so. And so you go to your Uncle Bob and you say, Uncle Bob, can you put 50 grand into my startup idea? So that's the pre-seed level. And then the seed level is now it's a little further along. Maybe we have some initial early customers. And now we need to really kind of invest some money in building out the product a little bit further. And that's typically called a seed round. And it's in the, $300,000, $400,000, $500,000 range. Kind of typically, again, there's a lot of variance on all these things, but that's kind of mid six figures is a typical seed round. And that's typically an angel investor or a syndicate of angel investors. 4 or 5 people get together, each put in $50,000, and there's your $250,000 seed round. Series A is the first institutional round. In other words, the first venture capital round. And that's at the scaling stage. So we've proven the model. We have real customers. We've proven that we can serve real customers profitably. And now we're ready to scale this thing up. And we need, $3 to $10 million in order to scale this thing up. And so that's the Series A round that we're talking to venture capital firms about. And then the Series B is the growth stage. This thing's on fire now, and we're ready to scale it up nationally. So now we need to go raise $20 million again from institutions in order to scale this up nationally. And the Series C would be, kind of the level beyond that this thing is totally on fire. We got customers all over the country. We're kicking ass, and we're getting ready for our IPO next year. So the important thing to understand here is that the pre-seed and seed is typically angels because, as you remember, they're the ones who are investing their own money. And so they don't have a fiduciary responsibility to anybody other than their spouse. And so they can make the more gut level investment decision that tends to be involved at that level. The Series A and beyond tends to be the VC firms because now we have some operating metrics. Now we have proof of market demand. We have proof of unit economics. We have proof that this thing is ready to scale. And so a venture firm can make an informed investment decision in providing the capital to scale this up. And so that tends to be the VCs. The earlier stage tends to be the angel investors. Important to just understand the stages. Okay, now we'll dive into tips and suggestions. And please, as I said, please put put questions there in the comments box. I'd love to get to as many questions as we can today. So my first suggestion is bootstrap as long as you can. There are a lot of reasons why you should try to self-fund as long as you can. The more you can self-fund a company, the more you can prove market demand, the more you can prove the customers are willing to pay for this, the better position you will be in to raise investment and to raise investment on favorable terms. So bootstrap as long as you can, and look at things like customer financing, where a customer will pay you to produce a custom version of your product for them. That's a great way to bootstrap a company. There's a lot of talk about product market fit. So Mark Andreessen kind of coined this term, which is that, it's a fit between what the market wants and what your product does. And that when you launch, those two things are out of alignment, and that the whole idea is to get those two things in alignment, get alignment between what the market wants and what your product does. And the best proof of product market fit is paying customers, right? That at the end of the day, that's the thing that impresses investors, is paying customers. So I hear people say things like, I have to make my clickable prototype, and once I have my clickable prototype, I can show that to investors and they'll fund me. A clickable prototype doesn't prove anything. The fact that you built a clickable prototype just shows that you have the skills of an average and middle schooler. What impresses an investor is showing that you have paying customers, that you have product market fit. And the way of proving that you have product market fit is that customers are handing over money to buy what it is you're selling. So understand that is the fundamental proof point that you're working toward, is paying customers. Consider the wide range of financing options available today, and which one best aligns your interests with investors' interests. As I said that at the beginning of this, there's a whole bunch of different sources and structures of capital today. I did a deal recently on nextseed.com, where I put $100,000 into the company. I get 3% of the revenue of the company is my payment back, 3% of the revenue, until I get 1.5% my investment back, and then I'm out. So, that's an example of kind of an alternative way of structuring a financing, and it aligns my interest and the entrepreneur's interest nicely. So get away from thinking that it's all about venture capital, and think about the wide range of different financing options available today, and choose the one that's right for you and the one that aligns your interest with investors' interests. Venture capital is great. For certain kinds of companies, venture capital is the right choice. Venture capital basically allows you to scale a company at an unnatural pace. That is the purpose of venture capital. So for Uber and Airbnb and all those kinds of companies, being able to scale at an unnatural pace, that's exactly what they needed to do. And they paid a high price for it, right? But not everybody is building an Airbnb or an Uber. So make sure you understand that there's a wide range of different financing sources available to you. Fundraising always takes longer than you think it's going to. It just does. And so start socializing the raise months in advance. If you think you're going to be doing a raise in November, then right now you should be socializing it, mentioning it to people, asking for referrals, having some informal meetings. You say, I'm not fundraising right now, but I'd love to meet with you, tell you a little bit about what I'm working on, and get your input on it. There's just nothing like socializing it early, because it'll end up making the process a whole lot smoother once you do get into fundraising mode. And also remember that most fundraising comes from referrals. It doesn't come from cold calls. It's very difficult to cold call your way into a professional investor. So when you meet people, socialize your idea, ask them for referrals. That's going to be the most likely way in which you will meet an investor who's willing to invest in your venture. And my last thing is just simply, we talked about stages, and then there's also sector focus. So every investor, every venture capital firm, or every angel investor has stage and sector focus. So just ask them, or look it up on their website, and they'll say we focus on early stage in life sciences, or we focus on growth stage in consumer products, or we focus on scaling phase in biotechnology. It's really important to understand that every investor has a stage and sector focus. So don't embarrass yourself and go pitch somebody who's not focused on the area in which you're operating. So those are some of my thoughts this morning, and I'd love to hear your questions. So Peter writes and wants to know about crowdfunding. Yeah. So crowdfunding's great. And Kickstarter in particular is great for pre-sales. So many of you probably know the Peloton story. So the founder of Peloton, he was shopping the deal around. He was going up and down Sand Hill Road and just getting no interest at all from investors, because investors looked at his Peloton and they're like, yeah, it's a stationary bike. There's lots of stationary bikes. And he was like, well, yeah, but it's got this screen on the front of it, and you can do live classes with instructors. And they're like, yeah, it's a stationary bike with an Android tablet bolted to it. So he just couldn't get any interest from investors. So what he did is he built a prototype, he put it on Kickstarter, and he said, this is this amazing new thing that I'm building. And if you would like to be one of the first to own one, you can pre-buy one for $1,000. They're going to sell for $2,000 when they hit the market, but you can pre-buy one right now on Kickstarter for $1,000. So he got 300 people on Kickstarter to pledge $1,000 each to buy the first Peloton. So that gave him $300,000 that he used to fund the first production run. And then once he had done that first production run, now all of a sudden investors were interested, because by doing the Kickstarter pre-sales, he was able to not only pay for the first production run, he was also able to prove market demand, right? 300 people pledged $1,000 each to buy this thing. That's how much they wanted it. So for that kind of use case, for the kind of pre-sales of hardware, Kickstarter is awesome. Kickstarter does not lend itself well to other kinds of products. If you've got a software as a service platform, it's very difficult to put that onto Kickstarter, because it's very difficult to pre-sell anything. And you can't actually sell shares of stock on Kickstarter. So you can't sell equity. You can't do an equity financing on Kickstarter. So crowdfunding is awesome. And it's especially awesome for certain use cases, and pre-sales of hardware products is perhaps the best use case. So Amod asks about non-dilutive startup financing. Yeah. So any kind of equity financing is dilutive, right? Because as people buy more and more of the company, then the percentage ownership of the founders and the previous investors is getting smaller. So that's the dilution happening. So the tried and true method of non-dilutive financing is debt, right? If you take out a bank loan, that doesn't dilute the equity in the startup any. Or some other kind of debt. The other kinds of non-dilutive financing we're seeing a lot these days is either, as I mentioned before, revenue-based, royalty-based, or there's an outfit called ClearBank, bank with a C, so it's Clear and then BANC. And what they do is that they basically, if you can prove to them that your customer acquisition cost is less than the lifetime value of a customer, so in other words, if we've got enough operating history that we can show that we can get a customer for $10 and we can monetize that customer for $30, then they will basically give you as much money as you want to fund your customer acquisition processes, because you've basically proven to them that you have a machine that turns $1 into $3. And so they give you what is effectively a line of credit that you use to fund your customer acquisition campaigns, and you pay it back on a percentage basis. So I believe it's 6 points. So in other words, if you take $1 million from them, run it through your sales and marketing, they charge you 6%. So $60,000 on $1 million, 6 points. And this is kind of their way of getting around banking regulations, because they're not charging interest per se, and so they get around banking regulations. They're also not taking equity, so they get around the SEC regulations. And there's lots and lots of these out there. If you look up, I presume if you Google non-dilutive financing, these will show up. But first, just go to ClearBank, Clear BANC, and click on the little tab there that tells you about how it works, and that'll give you an idea of one of the many forms of non-dilutive financing out there. Let's see. Juan asks about raising capital for telemedicine in Latin America. Yeah, so telemedicine is certainly a growing field. I mean, anything having to do with medical technology is a great growing field right now. And with regard to Latin America, the great news is that there are a lot of venture funds and investors these days focusing on Latin America. So that would be my first suggestion, is to spend a little time. Mexico City has a pretty good venture capital industry. Brazil has a very good venture capital industry. Sao Paulo and Florianopolis have a lot of venture capital firms, and a lot of them focus, specifically on the Latin American market. And most of them speak English. You don't have to worry about Portuguese, because Portuguese is hard. But I would look at Brazil. I would look at Mexico City, and I would look at Ecuador. Also has a very good flourishing venture capital business. So I would start there, because you're always a little more likely to raise investment from people who are in that geography and focused on that geography. What else? So Sarah asks about, we're in the concept phase, and we need investment to build a web platform. Is this a realistic request for investors? So yes, Sarah, at the early angel stage. So in other words, if it's at the concept stage, you can't really pitch a venture capital investor. You can't really pitch an institutional investor, because you just don't have any operating metrics to show them. You just simply have an idea. It's it's Sarah and a PowerPoint deck. So that level of investment tends to be more, your rich Uncle Bob, or some other family and friend source who knows Sarah, trusts Sarah, and is willing to make a gut level investment in Sarah. And that's very common. So yeah. Then Amod asks about having a founding partner in a different country. Does it complicate things when raising money? I don't think it necessarily does. I think, let's just think this through, Amod. So what investor really cares about is mitigating risk. So the investor lens always is to look at a deal through the lens of where is the risk here. And a partnership breakup is always a risk, right? And so it's certainly possible that an investor would look at something where one of the partners is here, one of the partners is in a different country, and he can't get a visa. It's possible that an investor would look at that as being a risk. But I think you just need to kind of think that through in advance, and have a good way of describing it such that it does not seem to be a risk. Also, India has a pretty good venture capital industry these days too. So if you could put together an investor syndicate where some of the investors are U.S. based, some of the investors are Indian based. One of the founders is U.S. based, one of the founders is Indian based. That kind of starts to seem like a pretty solid arrangement. So I think that's my input on that one. Mode is just it's not a problem, but think through how you make sure that an investor doesn't see it as being a risk area. And I think that's it. So I've kind of wanted to keep this to a half an hour this morning, guys, and I think we're slightly over that. So hopefully this has been a helpful just kind of introduction. And again, the fundamental thing I want you to remember is that there's lots and lots of different sources and structures of capital today. So take your time to understand the terms that I discussed today, understand debt versus equity, understand how equity financings work, understand how liquidation preferences work. Take the time to understand all of that stuff. Socialize the idea first, ask for referrals, and then make sure that in the end, you're pursuing sources and structures of capital that align with you. That getting alignment between investors and entrepreneurs is probably the most important thing. So enjoy. As I said, the money is flowing freely right now. So get out there and make the best of it. And feel free to follow up with me if I can help in any way. I'm Brett Waters, and some people have very complicated usernames, like Fluffy Pony 123 on Instagram. I am just Brett Waters on everything. So I am brettwaters@gmail.com. My Instagram is Brett Waters. My Twitter is Brett Waters. My Clubhouse is Brett Waters. If you want to send me money, my Venmo is Brett Waters. So I'd love to hear from you if I can help out in any way. If you have any questions, send an email to me at brettwaters@gmail.com, or find me on LinkedIn, or whatever is your preferred communications method. Thanks very much, you guys. Thanks for joining. See ya.